Okay, hopefully that now you've got audio. Let me just check and make sure. Do we have audio now? Okay, great. Okay, thank you. We got about 25 phone calls that we had no audio, and I apologize for that. I'm going to start over, and you really didn't miss much. You missed the mandatory disclaimer, which I projected, and I'm not going to reread. It's right there. And what I really did was move right to our order flow assessment. And I'm just going to start over because you missed very, very little. And what I was talking about was that order flow itself, the volume ladder itself, is looking at the disparity between the number of buyers and the number of sellers sitting at each individual price level, depending upon what you're trading. This could be a tick, this could be a pip, or this could be a cent. But every price level has a fixed number of buyers on the dome and a fixed number of sellers. Now, what these boxes are inside the candle are stacked buyers and stacked sellers. Now, remember that these are not executed trades. To look at executed trades, and I did it for months a number of years ago, and found it to be completely worthless. You have to, it's called chase the tape. And there is an indicator that you can configure that will actually show you executed lots crossing. And it can be filtered so that you can only look at individual lots of 25, individual lots of 50, but here you're looking at executed trades. Here you're not. These traders can come and go as they please, depending upon how aggressive they are. So the delta value calculated at candle close is 29.85. And it shows you that there's a marked differential in favor of buyers. There are far more buyers sitting on the dome than there are sellers. Now, if you use any individual price level to trade, and you look, I've seen representations of hidden buyers, hidden sellers, individual tick levels, pip levels, or cent levels being areas of support or resistance. They're just not powerful enough. They're too weak. Stack buyers and stack sellers within an individual candle, too weak. And you're going to see the problem with this actual number. Now, one thing I did want to mention is that the order flow legare system I'm going to show you is really an upgraded version. We've added some really nice features to it, and we've really made it incredibly powerful. And I'm going to show it to you live. We got a live market right now, and I'll show it to you at any time frame you like on any instrument. And that's how I opened, and I just want to let you know that that's where the pedal hits the metal is a live market. But I want to explain to you what you're looking at, which I think is really important. So here's the market delta value of this candle. Now here's the market delta of this candle. It's a positive 222, but the candle closes down. So why did that happen? Why are there more buyers on the dome than sellers, yet the candle closes to the downside? This is why trading simply the absolute value of the market delta can get you into big trouble and can get you stopped out. Just because the market delta is sequentially increasing in magnitude doesn't mean the candle is going to close in the direction of this number. And it can be an enormously positive number and still get a down close. And the reason is it does not take into account the aggressiveness of the buyers and the aggressiveness of the sellers. If the buyers Let's just say, for example, the price is 70. And it doesn't matter what instrument you're looking at. It could be a stock, it could be a future. I mean, let's just say it's a Forex market. The buyers only want 70, and they're not going to pay more than that. But the sellers are so aggressive, they're not just going to take 70, they'll take 69.9. Excuse me, let me just put this on mute. They'll take 69.8. They're much more aggressive than the sellers because they believe with far more certainty that the market's going to fall. So even though there's more buyers here than there are sellers, the candle closes to the downside. That's why this number is helpful, but it doesn't give you an absolute candle direction. Now, a lot of traders are taught that it does, and it just does not. Now, if you look at a whole sequence of market delta values, and you look at a curve like this, you can see why this curve has absolutely no predictive value as to where price is going to move off the right edge of a chart. Let's say you can see that the market delta absolute value is rising. Comes down a little bit, but the next candle, if it was all the way up here with a huge positive delta, it could still close to the downside. So this is what most indicators push at you. And it's just not going to help you off the right edge of the chart. Now, here's the fact. The fact is that one standard deviation's worth of data works. So on a bell-shaped curve, if you can take all the market delta values in a single standard deviation, they're going to basically almost always close in the direction that they indicate. So what you have to do is throw out the outliers. Throw out maybe the 1 in 3, 1 in 4, 1 in 5 candles that close in the opposite direction. Here's a minus 220 to the downside. Here's a positive 348 to the downside. We need to eliminate these outliers and stay with that single standard deviation's worth of data. Then the market delta value becomes important. In addition, it's really sort of my mantra, and one of the things in my trade, sort of in my trading Bible. And if you're in my trading room, you know, I don't believe any data that's taken off your trading chart itself has any future predictive value. This is all lagging, and you just can't get any valuable data, even from that single standard deviation, if it's coming off your trading chart. What you need to do is to look at the 2 higher multiple time frames. So what we do is we look at the delta value of each candle on the 2 higher multiple time frames. Now, in the room, I trade a Unorenko chart. You can trade any type of chart you want. You can trade range, time, tick. It doesn't make any difference. The indicator algorithm is set so that whatever your trading chart speed is, let's say your trading chart is 2 minutes, it's going to look at the 6 minute, which is 3 times 2, and then 3 times 6, and the 18 minute. And it's going to look at those 2 time frames and look at nothing from your trading chart. And it's going to look at the delta values of those higher time frame candles and put them in a 15 period simple moving average. Now the 15 period average, because it creates the average delta value over the last 15 candles, smooths out the data and throws out the outliers. And because this is data coming from your higher time frames, it's going to lead your trading chart. We don't want an indicator that's driven by price on your trading chart. We want an indicator that's driven by price on the higher time frames, so the price on your trading chart is going to be driven in that direction. So when both 15-period simple moving averages are sloping up, the bulls are firmly in control. And you're going to see there's a significant amount of buying pressure in the market, because you don't get these aligned to the upside that often. And when both 15-period SMAs are sloping to the downside, then the bears are firmly in control of the market, and we're looking at the higher time frames. And when both of these moving averages are not moving in the same direction, which happens often, you're going to get a yellow, and that's going to oftentimes define chop. And what really is chop? I mean, if I had the time, I would show you something that's really, really cool. And I might do that in a second. But in a closed system, there's certain forces that come to bear on price and determine how price is going to move out into the future. It's our job as in mathematical modeling, which is really what I do, what I did in my undergraduate and graduate work, is to create a mathematical model that defines the forces that move price in this closed system. And I've depicted that visually in a very, very cool way that I'm going to be putting out soon. So here's the way you're going to see it on the charts. Now, I told you that the delta, market delta, it's a very, very labile value. And even with the smooth 2-15 periods on the higher time frame, sometimes it's going to give you a down move in a strong uptrend. But if you just look at the line, and you'll see this live, it's going to turn before price turns. So once those 2-15 periods are moving up, and the data is coming from your higher time frames, and the 15 periods are basically almost eliminating the outliers, it's showing you that there's significant buying pressure in the market. Now here it turns for a bit. And when I show you the full chart, you're going to see why you can't counter trend trade this, even though order flow changes. And when it goes green, you've got your next nice move up. Now, if you try to counter trend trade against the direction of this assessment, you're almost guaranteed to get stopped out. It's not 100%, but you're calling a top, and that's what these traders are trying to do. And order flow does change briefly, and you're going to see that there's more forces involved than just order flow. But order flow is one important independent variable or independent force, and the reason it's independent is because it's been unlocked from price on your trading chart. If it is locked to price on your trading chart, or use price on your trading chart as part of its assessment, it becomes a dependent variable, and those are useless. And if you see this counter trend trade, it's absolutely got no chance. I mean, the chances of it. I mean, these traders are calling a top, but order flow is solid green, and they're going to get stopped out. And these traders are going to get stopped out for a little bit of a different reason that I'll explain to you in a minute. You want the next long move. Now here you can try to call a top, but I would not recommend ever doing that. I would recommend, I've seen a ton of stuff about this indicator calls a top, this indicator calls a bottom. I'm going to tell you later what really creates tops and bottoms. And there's no mathematical analysis that can do that with the precision that's required to make money. You can do it, but you're going to get stopped out multiple times trying. Now, they're taking oscillator divergence, they're taking MACD divergence, maybe they're trading off of Fibonacci resistance or something. but they're not going to get a counter trend trade when order flow is green. And here's the same thing. It's going to turn first, and you're going to see that on the candles, and I'm going to show you. And you have to trade in this direction. You see this counter trend move, it is not going to work. Once in a blue moon, they'll call a top, but it's simply not happening. And you're going to take every long pivot as long as the order flow is green. Now here, the reason I put this example in is there are actually long periods of time where order flow is yellow and it's just neutral. And it's not going to give you any entry at all. And that's going to define chop, where you just don't trade. When it's green, you've got a long bias. This is not an entry signal. It's simply a directional bias. And let me tell you, a directional bias is 80% of the fight, to know what direction to trade. And then later we'll define a trading entry. Now here's where order flow keeps changing in color. And you can see what happens to price. Now, as a single independent variable, you don't know if this red's going to continue on and on and on and on. But retrospectively, to analyze its power, we can see that if it continually changes, the market is going to chop. And once it goes green and stays green, you get your nice move to the long side. So it has tremendous predictive value. And the reason these candles, these are Unirenko candles, but you don't know the instrument, you don't know what market, you don't know what size, because those are irrelevant. It doesn't matter whether this is a stock, whether it's a Forex market, or whether it's a future, whether this is a long-term Unirenko that would give you a swing trade, or a short-term that would give you a day trade. It doesn't make any difference. This force is effective on any time frame. And the fact is, if the force that you're looking at to move price is not universally applicable across every financial instrument and every time frame and every market, it's got to be broken. If you're told it works on Forex but not futures, or stocks and not, but not Forex, or it works on time but not tick, something's wrong with it. As a closed system, it's either a force that moves price or it doesn't. And it should be totally irrelevant the method that you use to look at price: time, tick, range, Unirenko, or even Renko. Although I can tell you I don't like Renko for lots of reasons I'll go into in a sec. Now, what I want to do is actually take this deck off and move to another deck. So I want to show you here our legare. Now, I had to make a new deck because it's changed quite a bit. And for those of you that are new, I just want to give you a little bit of a quick background on oscillators in general. They were created by George Lane back in 1957. And George Lane, and I want to go through this pretty quickly because I know some traders have been in the room before, and I don't want them to fall asleep on this. But I think the background behind it is really relevant to trading. He created it, and he was a really brilliant mathematician. And the fact is that the guy died a pauper. I mean, I think he died a homeless person. But he's a brilliant guy, and besides creating the stochastic indicator, he did a lot of other work in math. If you Google this guy, you'll find a lot of stuff that he built and created. And he created the first oscillator, stochastic. And it's important to understand that stochastic is a second order derivation. It doesn't measure speed, it measures momentum. And momentum is the rate of change in speed. So if a race car is going around a racetrack at 100 miles an hour constantly, momentum is flat. If it accelerates in price, accelerates in speed, momentum increases. If it decelerates, momentum decreases. So when you're looking at an oscillator, you're actually looking at price acceleration to the upside or acceleration to the downside. And he felt that that had forward-looking ability because it was a second-order derivation. It wasn't looking at price speed, it was looking at the change in price. So, he felt back in 57 that it foreshadowed reversals when you got a bullish or bearish divergence. And I believe back in 1957, the guy was right on. I think that a bullish or bearish divergence signal off of his stochastic indicator was a very, very high probability winning setup. Now, I really went over this about the rate of change in speed as opposed to a constant velocity. Now, what's changed from 1957 to today, and why, if you try to trade divergent signals, are you going to get beaten up? And it's, I mean, as far as I'm concerned, it's not up in the air, it's a fact. And here's, I think, the key to trading. If an indicator signal works sometimes, but not other times, and you can't tell when it will work and when it will fail, you cannot use it, because you have to use an indicator in which you can make an assessment of risk. And when risk is totally unknown, then the indicator signal becomes a question mark and becomes useless. Now, back in the day, it probably worked really well. But what determines now tops and bottoms and what drives the market is really all institutional money. What calls a top in the market? Institutional money. What calls a bottom? Institutional money. You can get multiple divergent signals. And if institutional money is not done pushing your stock or Forex market or futures market to the upside, it will go overbought, and it can stay overbought for minutes, hours, days, weeks, and even months. Now, in between that period of time, it can slip into multiple divergent signals. But as long as big money is still in the trade, you're going to get run over time after time after time. Now, if you can't determine when institutional money is going to step aside on a trade, what mathematical derivation can call a top? The answer is none. So the only thing that you can do is be in on the trade as early as possible and run with it in the direction that institutional money is pressing it as far as possible. But you're never going to anticipate that institutional money is going to step aside and try to counter trend trade it, because you don't know that's ever going to happen. So you can't trade divergence, and ignore, please, what you do. Do not try to assess or a top or a bottom, and I have tried to do it. I spent 14 years trying to create an accurate way of calling a top or a bottom. You know, double top, triple top, and double pivots. It doesn't work reliably as long as institutional money is still pushing the instrument up. And it's going to go right through the pivots and run you right over. So that's what's changed from 1957 to today. We can't use an oscillator, whether it's stochastic, whether it's RSI, whether it's Williams percent K, and those indicators are created to look for divergence. They're not created to go with the trend and look at the speed of the acceleration of price to the upside. They're created to look for divergence, and we don't care about divergence. So we don't want to use an oscillator that's based on finding a signal that we don't want to take. And that's the beauty of the legare. Now, the legare is an oscillator, and an oscillator is any indicator, and it requires 4 parameters to create an accurate percent K line: the open, high, low, close of every formation. And you'll notice that it does not work on a Renko. A Renko has a high and a low, but it doesn't really have an open, close, high, low. And it doesn't have 4 individual parameters. And I've seen $17,000 software in which their key parameter is a legare, which can't work off a Renko brick. You must have a wick, and that's why you have to know the formula. And the formula is really easy. This is just the stochastic oscillator formula, because they're all based off of this general principle, which is really important. Now, C is the most recent closing price, and then it creates 2 moving averages. One moving average is a 14 period of the session lows. The other is a 14 period of the session highs. And it looks to see whether the close is moving towards the session high or moving towards that 14 period session low. If it's moving towards the low, price, well, what is happening is it's looking for the close, it's looking for C, the most recent closing price, to approach the low price of the candle on a short trade. And it's looking for C, the closing price, to approach the high on a long move. And as long as it keeps inching towards the high in this 14 period session, momentum is moving to the upside. And as it continues to approach the low, it's accelerating to the downside on this 14 period average low close. That's what creates an accurate percent K. We don't care. We're not looking at percent D, because percent D is just a 3 period of percent K. We don't care about the crossover. We just want to know what is happening to the percent K line. Is it accelerating to the upside? Is it moving to the upside, indicating price is accelerating up? Is it moving to the downside, meaning price is accelerating to the downside? Now, price acceleration is something that's a very complex metric. Like, we're accelerating all the time. That's the reason why we don't fly off the face of the earth. We accelerate down to the ground, even though we don't move towards the ground. I don't want to make this too complicated, but if we don't accelerate to the ground at 9.8 meters per second, we're going to float up. I mean, that's what gravity is. It's an acceleration of force to the downside. So it's a little more complex than what I'm telling you, but it's extremely important in determining the direction that price is going to move. Now, back in the old days, the divergence signals, and this is an old chart I took off the internet, and you can see the double top, the divergence signal, and then the second high doesn't quite make it, but momentum only gets this high, and then price collapses because there's no institutional money here. It's just driven by commercial traders, and they can't make it up, and the price acceleration to the upside here cannot make it back to the previous point. So that's gonna create the harbinger of a collapse in price, and it's going to do so reliably. And I just gave another example. I just created it. Price makes a higher high, but momentum does not make a higher high. So price accelerates up to here with this much momentum, and it accelerates higher on the same momentum. If it goes higher, momentum should go higher. This is another form of divergence and a collapse in price. Only it's just not operational anymore in a market today that's driven so much by institutional money. And yesterday, I mean, if you look at the NASDAQ, or you look at most stocks, or you look at index equities, I mean, the Dow is up, what, 400 points? Try to counter trend trade the Dow. Institutional money yesterday was just driving price up. And if you wanted to get a minute pullback at incredible risk, you could counter trend trade. But it's just crazy to try. Institutional money is running the show. And now I created a divergence failure, but it looks awful, so I'm gonna just throw it away. Now, also, the stochastic was a great indicator for calling the direction. When the stochastic line crossed the 80 to the downside, you got a great short signal. When it crossed it up above the 20 line, you got a decent long. Here's back up, a decent long. Here's an enormous long. Here's a short that goes nowhere. And this just doesn't make it as a signal. Here's a beautiful short right here, and here's a great long. So stochastic really gave you a great, right off your chart, a great advantage in trading back before institutional money became played such a big prominent role. Now, if there's no institutional money present in the market, it's likely to chop. So you just don't even want to trade the market. Now, here's what happens. And I know nothing about this company. The only thing I wanted to do to demonstrate here was that overbought doesn't mean overbought anymore. And that the market is going to continue to rise as long as institutional money pushes this instrument higher. And this is the 13th, the 22nd, the 26th, the 27th, the 14th. This is a multi-day time frame assessment of this stock. And we don't care what the stock is. And that's why I didn't care that I pulled this. I just found this quick, so I used it. This is what's going to be present on every single instrument. As long as institutional money is driving it up, you're not going to counter trend trade it or trade divergence. So what you really want to do is use indicators as a proxy for institutional money. Now, here's another, I think this is kind of a pearl. And I hope if this is the only thing that you take away from this webinar, and I try not just to make this a sell, and I've been in a million webinars where I listened to 45 minutes of the guy, talking about his background, where he started off living under a bridge, and then he woke up one day and God came to him and gave him 3 trading secrets, and now he's a trillionaire, and he spends 45 minutes talking about his story. And I don't do that at all, because it's worthless, and you don't have to care that I do have many years of formal training, and I've published 15 peer-reviewed articles. I mean, I'm not just a guy who woke up one day and decided that the market was something I wanted to do. I mean, it's a closed system, and I'm analyzing it with mathematical modeling. Now, when oscillators were developed, there was little institutional volume, and here's the key. The power of each buyer was approximately equal to the power of each seller. If that was the case, that made a divergence signal really a good signal. Do you know what else it made really good? Japanese candlestick patterns. 400 years ago, when the Japanese rice traders created Japanese candlestick patterns, the power of each buyer was approximately equal to the power of each seller. There was no major monster buyer or seller, or that one would come along once in a blue moon. Essentially, everything was equal. So Japanese candlestick patterns were extremely powerful. Now I still like them, and I believe that they still have a lot of relevance. But if you use them to trade now, they're going to fail on you a lot. And I know them back and forth. I know bear failures, bull failures. I mean, I know them all. I mean, I've read all of Steve Nissen's books, and I've studied them until I'm blue in the face. And most of those patterns are just irrelevant at this point, because institutional money has simply changed the landscape. that in which we have to assess trading. And that's why we have to be really careful what we learn and what we're told and what we use to trade, and why most traders wind up getting beaten up, and why they lose their trading account, because they're just given information that's just not right. Now, here's my recommendation on how you have to trade in an era of institutional volume. There's no such thing as overbought or oversold. It's just a fallacy. The market's going to turn when institutional money decides. The markets reverse at the whim of institutional money. Look, you see what happens when Trump pops a tweet. I mean, if he tweets that trade with China is going great, the market goes up 400 points. Are you going to try to counter trend trade that? That's institutional money at work, because risk is on now. You got to go with that money. That's the power of it. Now, reversion to the mean still applies. Price is always going to try to revert to the mean. But institutional money can pull it 2 or 3 standard deviations off the mean. But at some point in the future, price will always come back to mean price. That will never stop forever. Mean price is important, and it doesn't matter what you define as your mean. It could be your 100-period moving average, your 50-period moving average. It could be the point of control. I mean, I like a moving average because it's the average close going back 50 periods or 100 periods or 200 periods, and it applies directly to mean price. But you have to define that. But whatever mean you define, price will have that centrifugal force to come back into it. So trading divergence is tantamount to trading against institutional money, and it's fraught with risk. And our goal as day traders is not to get winners, it's to avoid losers. Everybody can get a winner, but almost nobody can avoid trading almost every loser, avoiding every loser. That's the key. In this case, we always trade in the direction of institutional money flow, which brings us to the legare. Now, here's the formula for the legare. It's much more complex than a standard stochastic indicator or a standard oscillator. It's got multiple smoothing filters, which we have modified, and it's got a gamma, which we have changed. And all these inputs change the speed of the %K line and how much it's going to get jockeyed around by price. So we want a fast line, but we want a stable line. And only the legare gives us the ability to do that. The other formulas are just all modifications of that simple one that I gave you. And that's why the legare is unique and a standout. And I didn't really do much research on the legare as to who created it, who developed it, but it's really a brilliant indicator. And it's a step above, I believe, all the other indicators. I'm going to show you that. Now, remember, we always look at a multi-time frame assessment. I don't care what's happening on the trading chart. But in this particular case, we have to look at momentum on our trading chart, but it has to conform to the momentum on the 2 higher time frames. Now, momentum is assessed, I don't have a slide, exactly the same way as order flow. It looks at the 2 higher time frames. And if the legares are accelerating away from the signal line, momentum is up. If the legares are accelerating towards the signal line, momentum is down. And if on the 3-minute, it's looking at the 9-minute and the 27-minute. And that's your top line. Your bottom line is the legare on your trading chart. And the only time you're going to take a trade is when the legare on your trading chart is moving in the same direction as your long-term assessment. And this is just not assessment of trend. This is an assessment of price acceleration to the upside. And you want that multi-time frame direction. and wait until the gear on your trading chart moves up. Now you're going to see we made a substantial upgrade on this indicator, and it's a lot easier to read than it is now. And we've taken these arrows off, and I'm going to show you that chart. But you can see this indicator begins to head up into the green long term to give you a long signal right here. And as soon as your gear on your chart crosses below the 80 line, you're out. Now it would be this arrow, but I've removed these arrows. That's a 3 minute. Here, where there's no correlation at all, you're just going to move and chop. And any trade that you try to take is more likely to blow up in your face than it is to give you a winner. Once the gears kick in, both the multi-time frame, pulling the gear on your trading chart up, you're going to get a great entry. Now, the software signaled the entry right here. And if you took the entry here with a reasonable stop, you got a really nice move. This is a 3 minute move. Again, I pulled the instrument out. No, I don't know if this is a tick chart or a time chart. I wanted to make that irrelevant too. It's no longer a Unorenko. Oh, it's a 3 minute. It's a minute chart because it doesn't matter. And I want to impress that upon you. I don't care what you trade. I'm not trying to give you a trade methodology which forces you to trade a time, tick, range, Unorenko, whatever. It shouldn't matter. And here's another example. You've got the gear. There's the arrow actually signaling your entry. Now, you could have exited here, but that long-term gear just stays green, which means price remains not just heading to the upside, accelerating to the upside. Now, it's a little riskier to stay in here, but you can always go right back in and get this big move up. When price does not correlate, this is complete chop. And that's what you want to avoid at all costs. And I'll show you this on a live chart. And I think it's going to really surprise you. Here's the same thing. Now we've got, look at the gear on our trading chart. There's so much selling pressure here that it's locked almost at the 0 line. And the long-term gear, both higher time frames, are locked at the 0 line. The software gives you an entry here. And you get this small dumbbell counter trend trade. And there are always going to be traders looking at divergence, MACD, oscillator divergence, trading some crazy bottom calling system. We're going to go right back in if we're stopped out and take it down again. And let me tell you why these long traders help us. When you trap 2 candles long and then run them over, they're all going to get stopped out. And what do they have to do? Sell their contracts, sell their shares, or sell their lots. And if they have to do that, they're going to help push the market in our direction. So if we can take a trade off a small counter trend move, it makes that move down even more powerful. So we always try to catch traders in the wrong direction and leverage the move to give it that much more push to the downside. I mean, we got to exploit other commercial traders and stay in the direction of institutional money. Let them take the beating and let us go home with the money. And that's really what it comes down to. We're never going to take money from institutional traders. We don't trade with them, we're going to also lose money. Here's another example. The oscillator crosses below the 80 line right here. Now we've made this a lot easier to read. The long-term gear is already red. The 2 higher time frames are already accelerating to the downside. Once price on your trading chart starts to accelerate in the direction of the longer term time frames, you got your entry and a huge move down. Now, I don't know how much further down it went, and it's irrelevant. I just wanted to use this to show you If you traded long here, you're going to get really beaten up. If you trade short here, it's almost impossible to take a loser. Now, one of our rules is, and the reason why, and those short counter trend trades that you saw on order flow, we don't take them, is we only go short below the 50 and long above the 50. And a short trade, and these are indicators you're going to get. You like the 50 red, and this is an exponential of an exponential. It's a specially formatted line, but it's a very fast, stable 15-period moving average that runs at an exponential speed, but has much more stability than a standard 15 exponential. When they're both red and price is below the 50, that's our short. If this was to turn green, whoops, hang on. If this was to turn green, we would not take a long. We don't counter trend trade. We don't go long below the 50, even if the legares tell us to. We wait till price breaks above the 50 turns green, the 15 crosses the 50. That means we don't get every trade, but we almost avoid every loser. And that's our goal. We're always going to have to let winners get by. That's what specificity is all about. If you trade with sensitivity and try to get every winner, you're going to pull in tons of losers. And here's another trade. Man, now this is a pullback. And anybody who comes aboard, we're going to do a master class, and there's 3 trade entries. One of them is a pullback into a defined uptrend. Maybe, so you can't get into this trade until the 15 crosses the 50 to the upside. It does so, and you have both legares locked green. All you need is a pullback. And once you get it, what does that tell you though? Why do we wait for the pullback? Sellers are here and they've tried to turn the market. And this candle is called a bear failure because the traders created this wick. And that pullback failed. The candle started heading up. And as soon as it heads up, you put in your buy stop. If the candle doesn't close to the upside, it doesn't execute. If it does close to the upside, you're in and you ride it up. It's a really easy trade to execute. You get back in here too. If you've got a full winner, depending on your automated trade management strategy, and you wanted another entry, you got it right here. You can get right back in. Here, the move is overextended. I mean, there's only so many times you can go in. It starts here, and you just can't take it up forever. Eventually, you're going to get a retracement, and then it's going to head back up. But it gives you 2 terrific long entries. Here's a 30-minute. Now, this long entry we cannot take until price rises above the 50 and the 15 crosses, and it's right here on this wick back and this move up. And you get a great move. This is not going to, you're not going to get a system signal here. You have to just wait. And this is what I'm going to teach you in the master class, that you're going to come in if you come aboard. And these are really easy trades to execute. Here's a 3-minute again, and these are short trade. Now I could show you JPEGs until I'm blue in the face. They mean what they mean. But really what is valuable is I'm going to show you a live market. And you can see as soon as the chart legare starts heading down into the direction of the long term, there's your short entry signal, and down you go. If you try to trade against this, you're going to lose. Here's a 60-minute. There's your short entry, right off the cross of the %K line down from the 80 line, crossing the 80 line. The long-term legare is already red. Forget it. That's a gigantic move. These are hour candles. And I wanted to show you that it's operational on any time frame, because it's really important that you You don't have to ask, well, does it work on this time frame? It doesn't matter. You can create daily bars, weekly bars. It doesn't make any difference. These forces are operational, and it doesn't matter what the time frame is. Now, these are too long signals. We know we can't take. We're not going to trade long below the 50. Now, this is an important slide for one reason. I wanted to show you the difference between where the legare moves and where the other oscillators move. And this is really important. There's your legare short trade right here. The legare starts heading down, and the long term's already red. So you got to trade short, and you want to stay in the trade as long as you can. Now, the first line is just your standard stochastic. And you see, it's looking for divergence. It gets you in on the cross here to the downside, but it bounces really fast right back up, and you're out of the trade. And you still have all this way to go. It's not looking to trade momentum as a trend trading tool. It's looking to create a divergence signal. The bottom line is relative strength, is RSI. RSI doesn't even give you a trade. So you can see there's a huge difference between the way we have configured the legare and the way your standard stochastic and standard RSI work. Even on a multi-time frame basis, these are not going to give you what you need to get into a trade because they're not configured to look for what we're looking for. They're configured to look for divergence, and we want an indicator that's looking at the acceleration of price in one direction or the other and doesn't give a hoot about divergence. It will give you divergent signals, but I just ignore them because I don't care about them. Now, I'll give you the offer before I go over to the live charts. The whole system, it's normally $19.99. The special $6.97. It's lifetime. You never pay us another penny. You get free upgrades, and man, did we upgrade it. And everybody who already has it got all the upgrades for free. You also get a 10-module weekly educational training. It's a huge amount of educational material. And I really believe in education. If you don't have educational support along with a trading tool, it really minimizes its power no matter how good it is. You also have our video tutorial library. We have 450 videos. And Sergio will configure this for you, white glove. I mean, if you want it set up on multiple time frames, like if you want to actually trade a 5-minute, you want to trade a 10-minute, he'll configure these for you on different time frames. And I've never done this before, but you get 2 months in the live trading room with me. That's a long time. And today we got our 3 winners and out at 7 minutes after the open of the NYSE. And then I spent an hour and 15 minutes teaching. So it's not only what I believe is great trading, it's also a tremendous amount of education. And I'll show you today, if you hang on a second. Here are our trades. Whoops. Hang on. We had a good day yesterday too, but I want to just show you today. Now, I do this every day. I show this in the trading room because I'm incredibly transparent. And we had our first trade. It was the first target, we just made 60. Our second trade was on the NASDAQ. First target, we made 100. Our third trade was on the NQ. We made 200. That trade was taken at 9:35. Our rule is 3 trades, 3 winners in a row, and you must close. It's called money management. Other traders traded on, and there were actually some really nice setups. But we were 3 and out, and I opened the room at 9 o'clock. We got no we did get a pre-market trade on crude at 9:17. And then we got one right at the open on the NQ. And then 5 minutes later, we got another one on the NQ. And I watched 4 markets: gold, crude, NASDAQ, and E-mini. And we were done. Very little commissions, no muss, no fuss. Now, if we could do that every day, that's $2,000 a week. Now, let me show you the charts, because I think that's really the most important thing. And let me find the chart here. And that'll answer any questions that you have. Now, I want to show you a few things that we've added that I did not mention in my discussion, which have really made this an incredibly powerful tool. First of all, the first line is order flow. Now, order flow is projected onto the candle bodies. If the candle body is blue, order flow is to the upside. If the candle body is magenta, order flow is to the downside. And you can change that halo color to whatever you like. Because here's the order flow indicator. I just have mine at royal blue, and I have mine at magenta, and I could make it any color I like. You can also make the thickness any color you like. So I wanted to show you this order flow line, but I want you to know that you can just eliminate it, because all the data is right on the candle bodies. And that's all you care about. And what I like you to do is to focus on the candle bodies themselves, not look below very often. Now, one of the configurations is the break of a pivot. Now, and I'll tell you why, and this is a little bit of what you're going to learn in the master class. Who's sitting in this pivot? A ton of sellers, because they turned the market down at some point previously. So the break of a pivot, which is a 2/3 candle close above, stops out all these sellers and pushes the trade up. And that's an awesome long trade. You can't trade into resistance. You wait for the break and you take the trade. Now, the other thing is, what we've modified and we've never used before is you can actually see price inside the Unorenko candle. You see the wicks? Those are really the wicks. So remember, Unorenko and Renko give you illusionary candles. I mean, the market doesn't have the symmetry of these squares. We configure it like this, but you can look right inside and see where price is. That's upgrade number 1. Now we'll go back, and I'll look at other markets if you want. And we can look for losers. I'll tell you, you're not going to find any. I mean, look at this continuation short trade. Remember I told you we're looking for the counter trend traders who go long in a market they're going to fail, and we're going to go short on the first down pivot we get. 50 is down, 15 is down, candle halo is magenta. We know order flow is down. Here's our long-term legare. Now, what we did was we created a signal B line. This is telling us what's going on with our trading, our chart legare, without even looking at it. You see, when it's heading down, it's now orange. When it's heading up, it's now green. When it locks short, it's red. When it locks long, it's green. So you really don't even need to look at this line. It's important to leave it in, but it just makes the trades even easier to take. Now, right here is your next pivot break and your next winner. because you've got the chart legare orange heading down, your long term is red, and there's your trade. So right here, you've got two enormous trades that are exceedingly low risk. And there's no pivots below. So you got a high reward trade. Here too. Now, you really need a pullback here. We can't see the wicks. The wicks only form in real time, and I just opened the chart recently. So when you go back, they only form when the chart's open, and that's because of the way the Ninja code is. So the wicks start, like you'll open your chart the night before, and so you'll get all the wicks. And this is how many wicks were created at the time that I opened the chart. And when you close and open, the wicks will not be held. Unfortunately, it's just the way that Ninja is. Now, here's a very small move. This may not be a winner, and I'm not going to tell you that every trade is going to be a winner ever. But here's your next entry, right here on this pullback. Remember, any retracement, we know that sellers tried to push it all the way down, and we have this monster move up. So if this one nicked us, we'll come back with a monster winner. And I'm not going to tell you every trade is going to be a winner. If I did that, you should close up. Here's another winner right here. Now here's another potential loser. This is a tough market. Here's another winner. Here's another winner. Break of a pivot. Now the winners are huge. So they're going to totally eclipse any problem you're going to have with losers, and you will occasionally get a loser. Here's another trade. Break of the pivot and down. Order flow, both legares lock short. I mean, now I can move this to any instrument that you like on any time frame that you like. So what I'll do is open up the questions. And if you want to see another market, you want to, I don't know if I have a stock data feed up. Let me see if I do. If I don't, I can connect it. If you want to see a stock, I can always add it. I don't have the stock data feed, but I can add a stock data feed. But every financial instrument operates the same way. And I'll just quickly go to the E-mini, just so you at least see more than one. Now here's the E-mini. Now on a Unirenko, you have to go to a 2, 4, 8, and all these settings we give you if you want to trade Unirenko. Now you'll notice we lost the wicks, inner wicks, and that's just the way it is. And you have to change the setting on the long-term legare from 13 to 8, because now your longer-term time frames have changed. Let the chart calculate. Let me make sure it actually changed on the MTF legare. Yep, input's 8. We're good. So now we're set up on the E-mini. So let's take it from 8 o'clock in the morning. Well, let's take it from the open. Here's 9:27. I mean, this is just a beautiful short at 9:32. I love the big wick. It shows that buyers tried to turn the market. They failed. You could have taken the trade here. That's pretty tight to the open. I don't trade the open. Here, you're 2 minutes out. This is a really nice trade. I would not take this continuation. I don't like to extend out on the E-mini. I like to take my trades tight to mean price. And if I can get, and this is probably 4 or 5 point move. Now, maximum excursion on this is just under 5 points. Doesn't mean you're going to get all 5. All I'm saying is from entry to its lowest point, it went just under 5. I'm not going to look for another big move. I'm going to wait for the retracement and look for the next move down. Now here you cannot take this trade. The chart legare is orange. It's not in the direction of the trade. Here, you can take it. And this is a small move, but this is the E-mini. And depending upon how many ticks you want on a first target, on this one, you're going to get 5. And this one, you're going to get 7 or 8. And then just get a ton of chop. There's nothing to trade here. You see this candle is haloed in blue. There's no short trade here. And here's your long trade. And that's the end of the day. So basically, depending upon your first target here, this is a 6-tick trade, no 5-tick trade. That's your smallest trade. Here you had almost 5 points. Here you had 5 ticks. Here you had a really nice move. And this is the only one. I mean, and here's also a really nice trade. The bottom line though is you can see that price is so likely to move in your direction. And this is 7. That's our first target. We're out on this first target. Here we would be short. But if we got this winner and that winner, we would make nice money. And that's the whole E-mini today. That's it. No, nothing else. And I look at any instrument you like. Like yesterday, the E-mini was a cash machine. And I don't want to pull this out. But look at this long trade right here. Now, notice this down candle. And this is really important for the software. I don't want to go too long. You see how it's haloed in blue? When a down candle is haloed in blue, it's telling you, hey, that next candle is likely to go long. Order flow turn first. The next candle's an up. Both legares are locked long. And look at that move up. And you're no way you're going to get out of that trade. Now, I don't think anyone's going to be able to call the top and get the whole move. But the trade went 8 1/4 points from entry to maximum excursion. That's a terrific trade. And you get these all the time. Here, the long is censored. Order flows in the wrong direction. Here's your great move right here. So well, you don't have a long trade here. The legare doesn't turn. And this is too mature to take at this point. Same thing here. I mean, you want to get in really tight. I'm just going to show you this last entry. This is the entry I love. The wick back to dual support with both legares heading up. And up we go. That's a terrific trade. This is going to make it. That's 5 ticks. 1, 2, 3, 4, 5. And look at this short move. Down. Back in. Down again. So again, you're not going to trade with 100% specificity, but you're going to avoid most losers and you're going to get signaled into great trades. Very easy to trade this system. You're trading with order flow and multi-timeframe assessment. And there's one more thing I have to show you, and then I'm going to take questions. Hopefully it's happened. Let me go to a market that's moving faster, because I really want to show this to you before I close up. I don't know, maybe the NASDAQ is moving faster. Let me move it to the NQ. Now, just hang on 1 second. When you see one candle close, I'm going to show you another major upgrade that's going to save you an enormous amount of money on a loser. And our goal is to minimize our losses and maximize our winners, the profit we make, and trade about 80% of our trades winners. Now, hopefully this is going to close. I don't care which direction it closes. I just wanted to do something. And then I'll answer any questions you have. Now, this is a recent upgrade, and it hasn't even been finished yet. We put it on the chart today, and Sergio is going to make it so you can change the color, the width, and also the right justification for this indicator. If you hang on 1 second. Now let's hope it closes to the downside. My God almighty. I'm sorry here. I mean, this is a NASDAQ. We should get like a couple of ticks here. Now, I forgot to put one indicator in here. It's the volume indicator. I want to add it. Because it's a very important indicator. I can't find it. But that candle still, here it is. Put that in. Now that's telling you how many contracts that are crossing per minute. And you can see how slow the NQ is moving. We always want to know that. Because if this is moving too slow, we don't want to take a trade. This is the best way to assess volume. Now, if this candle would just freaking close and give me a break, I'll answer any questions. Now, here's a short move, by the way, that worked, but I wouldn't have taken it in this volume. I mean, you don't trade a market that's deader than a doornail. Oh, come on. Now we do have the bar close. This is where it's going to close to the upside, and this is where it's going to close to the downside. So if you're going to take a short trade, you're going to take you're going to take your sell stop 1 tick below, your buy stop 1 tick above. You know what? Here's what I'm going to do. I'm going to make the candle smaller. I'm just going to make this a 6, just to get it to close, and make this a 1. And that's going to make the excursion a lot even less. Because all I want to do is show you a candle close. That's all. All right, here we go. All right, now you see this line right here? Hold on. This line is going to change. The market's moving really fast on this thing. Now here's exactly what it is. It tells you where to put your stop. If you went long on this candle, now you wouldn't do it because you don't have enough of a pullback. But if you did go long here, this is where your stop goes. It goes 1 tick below the low of the candle you're in. So if you got a deep pullback here, your stop the line would be drawn right here, and this is where you put your stop. So you're really taking a minimal stop, and you're really basing it on market structure. Now, these candles are all screwed up. This is not the size or anything you trade, but that's why on a short trade, you want to take a nice deep pullback. On the right edge, you're going to get a stop recommendation right here. You put your stop here. And if it does break the top of the previous candle, now this is a recommendation, it's not a mandate. And if you have chart trader up, which I should have up, it's going to, as soon as it hits, your stop is going to be in red. You just click and put it right here. And this trade, if successful, should never break the high of the previous candle. And if you do take a loser, it's going to be a small one. And that's a brand new. And you can see that black line. It's going to change. Now that I got the candles moving too quick, but it's giving you the entry for this candle. It's moving so quick. So I hope you got that all. But this is even giving you on a trade where to place your stop. It's a very, very conservative entry, and it's a very conservative stop. It's enough, if you take a pullback, it's enough wiggle room. It should not come back and challenge it. And if it does, you're going to take only a modest loss. And if you take a nice winner, it's going to run this loser right off the chart. Now, you can take a bigger stop if you want. Go for bigger targets. It's totally up to you. But this is an indicator we just created. If you want to take modest profit and take a modest stop. Now, let me answer any questions that there are. Now, again, I'll just show you the offer real quickly. And let me go back to the top because there's a lot of questions in here. Hang on. Hey, guys. Okay, a lot of them are, there's no sound, there's no sound, there's no sound. So let me just scroll past those. Okay. Okay, great. Okay, getting good audio now. Great, 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 great. The two, okay, I already talked. You know, somebody asked how the 222 is calculated. You know, the market delta, that's simply the summation of all the people on the bid with the summation of all the people on the ask. That's all. And we don't know if they're actually intend to buy. They may come and go. And we don't know their aggressiveness. That's why that 222 is an important number, but it's not important enough to trade and determine the direction of a candle. And that's why we use 15 of those numbers off of candles on the higher time frame to determine buying and selling pressure. Okay, hey Pri, almost everyone nowadays is telling to follow smart institutional money. Well, you know what? A lot of people, Pri, want to trade in the direction of institutional money, but they don't know how. And the only way to do that is to do a multi-time frame assessment of forces that really do move price. I mean, it's all well and good to want to do it, but I've seen traders say they can do it just by looking at Japanese candlestick patterns on their chart. Now, this system is based on a system that was created by Alexander Elder, who I kind of feel is like my mentor. He wrote a book in 1997, and in it he created what's called the triple screen method. And he believed that no indicator analysis on its own, unless it looks at triple screen, which is 3 time frames, was of any value. So you can say that you want to trade in the direction of institutional money, but if you're not making any money and you're constantly getting stopped out, you're not doing it successfully. So saying that you want to do it and doing it are two completely different things. And remember, traders trade divergence. You know, what do you say about that? Traders take tops, try to call tops and bottoms. I see people selling tons of software that's calling tops and bottoms 3 months out. It's, you know, it's worthless. So a lot of people get misled, and it's really a shame because it's just never going to be successful. And I think I showed you why. Hey, John. Yeah, we little guys are retail, not commercial, big money. Thanks again, Mark. Enjoy the weekend, and glad the hurricane didn't hit you. Thank you, guys. Thank you, John, for coming. John's in my trading room, and so is Ford. Hey, MG. Okay, the 15 and the 50 MG are this is a 15 period, it's called a modified slow. And what it is, I don't want to make it complicated, but I will tell you what they are. They're very unique trend lines. If I can find my cursor, here it is. Now, this one is just a 50 period exponential. That's all it is. It's a 50 period EMA. But this is a unique line, and nobody else has it. It is a 15 period. It's a 15 period. It's a 15 period exponential at EMA of a 15 period EMA. So what does that mean? Let me show you what happens if you overlay a standard EMA. This is right off of Ninja. I'm just going to put it in EMA. And let's make it a 15 period. And let's make it really thick. 5. And let's make it a dark color. We'll make it gray. Okay, now there's your standard exponent, your standard 15 period exponential. It's a moving average. We got to wait for the chart to. Now, what happens? Our exponential moves just as fast here, but you see how this is jockeyed by price. It's just, ours is a much smoother moving average. It doesn't get whipped around as much by price. So in a whippy market, it has more stability. So it has the speed of an EMA, but the stability of an SMA. And that's the perfect kind of indicator you want. Because you see the EMA point comes to a point, comes to a point, comes to a point, comes to a point, because price just jerks it around. R15 is very smooth and is much more accurate in terms of assessing market direction. And the cross of our EMA, of an EMA, with the 50 is a seminal moment, because that's when you can start taking your short trades. And it's a much better line than the standard EMA. I'm just going to take it off. So that's what that is. I didn't like the way the EMA moved, so we made a better line. And remember, this is all mathematical modeling to give us the best edge we can in trying to get a winner. So the EMA can whip us into a trade on one of those V-shaped moves. This will hold us back, and that trade could be a loser. We want to take we want to take the stability. This is same for the Forex, Bob. I mean, if I didn't tell you this was the NQ, the Forex looks exactly like this. The acceleration of price is exactly the same. And order flow, which is just taken off the dome on the bid-ask side, is the same on the Forex as it is on any other market. That's why I can trade stocks, futures, and Forex. And I don't happen to have a Forex feed, but believe me, if I could cover this up, this could be a Forex market. It trades identically. And if it doesn't, you can give it back if you buy it, because I'm telling you it does. There's no difference. The upgraded system will be available probably, the only major upgrade that we made that Sergio needs to is this line. The wicks, internal wicks, which are brand new, are already upgraded. This line here, which shows you the slope of the legare on your trading chart. Remember, this used to be yellow. It only showed a lock green and a lock red. This is already upgraded. All the major upgrades were already in place. The only thing we just built it, we just built it last night, is this very conservative stop, and that should be ready in a day or two. But we'll give you this system and upgrade and give you this upgrade, Monday or Tuesday when it's done. The only thing we want to add to this is its width, its right justification, and its color. Because so a lot of traders like a black chart, so they're not going to trade a black line. And if you don't want to use it, you can make it transparent, so you don't have to look at it at all. So Sergio's simply adding those parameters to it, and then it's going to go into the package, and you'll get that upgrade. So it's right there. All the important upgrades are done. Well, I could do, listen, I can't trade a market at this hour simply because it's dead. I mean, if we take, I'll just show you. If we take a real market, we have on the Unirenko, we have to trade a 10, a 4, 10, 20. That's a true Unirenko speed for the NASDAQ. And we have to change this to 13 because it's a slower market. Now it could take us 3 days to get a potential entry. But I could tell you, all I can do right here is tell you where I would go in. And I can guarantee you I'd be short here. Absolutely. Here you can't trade. Support, unbroken. It breaks, unbroken. It breaks, unbroken. And by the time it gets down here, you're not going to chase it. So you can't take any of these trades through multiple areas of support. This one, on this pullback, I mean, I would be in that trade in a heartbeat. That's what I'm looking for. And that's what I'm going to show you in the masterclass. What are these bulls trying to turn the market? That's all we need to take the trade short. Someone to run over. And this is called a bull failure. The bigger the wick, the stronger the bull failure. Here's another bull failure. Would have given us a lot of heat on the trade, but not stopped us out. Because the stop is one tick above the high of the wick. And we're in this all the way. And you can close it on the first up candle. So, I mean, I would be happy to trade it live for you, except I don't know if we're going to get an entry. Here's another entry I would absolutely have taken if we had volume. There's the pullback. And the legares are green, green. And the candle's haloed in blue. That's all I need. And I'm going in. And look how it's sitting right on the 15, right on the trend line. I can't take it here because my long-term legare is orange. And I have to wait until everything turns. It turns here, and I'm in. And the chances of this failing with a multi-time frame order flow assessment and a multi-time frame acceleration assessment on the legare are very tiny. Not every trade's going to work, and I'm not going to make that representation. But all you're looking for is a low risk, and your potential reward here is limited because this is where you're looking at your potential reward, right at resistance. And if you took the trade out right at the pivot, you'd be 100% right to do it. Just close it up. There's your potential reward. one second here. Right here it is. Right here. Now hold on one second and I'll show you. Hang on. Right there. I'm just moving too slow, unfortunately. Here's August. Just under $3,000. The whole month. Now, that doesn't include commissions, and it wasn't the best month we've had, but it was a rugged month to trade, and we still closed up. I mean, I can't fake this number. Almost $3,000. So that's the whole month, 8/1 to 8/31. And no one's going to show you this kind of data. Nobody. Except for me. Okay, Dwayne, I'll do it for you. I just don't want people to get bored, but I'll show it to you. Look, I'll go. You know what? I'll go back to that in a second. Dwayne wants a 5-minute of Apple, and I'll show it to him. Okay, hold on, DD. The stop loss pre is right here. I mean, it creates your stop. It's one tick below the low of your entry candle and one tick above the low of your entry on a long trade. It creates your stop for you, and you just click it and drop it on this line. This is a really great line, because remember that Unirenko is an illusionary candle. Now we're starting to create the wicks again, but this is the wicks are real, and it's creating for you the stop based on real price. That's what a lot of traders don't get, that inside a Renko or Unirenko, the price is a fake. But here we show you the real. You saw it before I rotated it. You could see the wicks. So we look at real price inside the Unirenko, which as far as I know, this is the only system that does that. And that stop is based on real price. So it gives you the stop on the trade, and it's the most conservative stop. The targets are up to you. On the NQ, on a moving market that's really moving, our first target's 15, our second target's 25. On a more conservative market, we take first target 10, second target 20. But our stop does not change. It stays the same. Okay, DD, can you confirm that all indicators and give you an accurate forecast? Listen, they are very accurate, DD. And the reason they are not lagging, they're leading, is because they're creating nothing on this chart, including the candle halo and the long-term legare, is using price on the trading chart to create its assessment. And so then why is price rising when these are both green? And that's the problem with most indicators. They look at price on your trading chart. So when price goes up, all the indicators go green, and it looks wonderful. But price is driving the indicator. In our case, we're not looking at price on the trading chart at all. We are looking at the higher time frame analysis, momentum and order flow. And when we get dual greens and order flow aligned to the upside on an entry, it's coming off the higher time frames, and it's the higher time frames that lead price. That's why these are independent variables. And that's just math. And if we created an indicator, then we must look at momentum on our trading chart. It's the only indicator we have in this suite. But it has to come into alignment with the longer term. And when it does, we've got to trade. But it's the longer term time frames and the multi-time frame assessment that is the leading, that creates the leading assessment. That's why you can make a great determination of where price is going to go off the right edge. Long above the 50, short below the 50. The closer you are, and this, I'm going to go over this ad nauseum in the masterclass. The closer you are to mean price, the greater the potential you have for getting a real big runner. And as you move off of mean price, you're still going to get a great trade, but everything in trading is based on statistics. Statistically, the likelihood of a huge runner becomes less. So if you stay fairly tight to the 50, now we're in the process of building another indicator. I want to tell you about, but you're going to get it, of making an assessment of how far off the 50 we want to trade. I mean, we want to put everything in your direction. I just gave it to Sergio to build today on all these upgrades you're going to get. But these are all leading indicators. That's how you can trade profitably. I mean, how could I make $3 grand last month if I'm trading with lagging indicators? I could have lost 10 grand. I mean, last month was a brutally difficult market. And we still wound up with a profit. The contract number, no, you can trade options. That means that's the contract number. Not, I mean, if you want to trade, and I'm gonna, because somebody asked me for a chart on Apple, I will show it. You can use this to trade options, but you're going to do that by looking at the price direction of a stock. I do have an options portfolio. It's called the Elite Trader, and we are killing it. Now, it's not hard to kill it in this market because the market is just really hard up. But I'm cashing out so many positions. I think we cashed out 5 this week for winners. And I personally take every trade I recommend in that portfolio. And just to give you I'll give you a real quickie because you're not here really to discuss options, but we cashed out Comcast, Sony, Comcast, Sony, I'm blocking on them, Microsoft, there's 2 more. We cashed out a lot of positions. Now I'm trying to get into silver on the big pullback yesterday. It's all off of the system. Now I think we're in silver. It's down $2. But we just have great positions. Cisco is just about closing in on a win. And I'm just getting very timid with tech because I'm looking to non-tech right now. And the big stock that I want to get into is a Brazilian company that it's their #1 5G company in the world. Well, in Brazil, and it's on a tear. So, and I just use this system. If I don't get, I use 2 things. If I don't have a technical set up long, and I don't see other options traders pounding the table on it, I won't take the option. No, they're not lagging. Evening trading room next week. Sophie, it's NT7 or NT8, but if you have Thinkorswim, it will power NinjaTrader. Or if you want to trade it off a demo, you can, and take the signals and trade it off your platform. The demo will last forever, and the demo data feed you're going to have to renew every 3 or 4 weeks. I shouldn't say it, but I'll have to cut this out of the webinar. You just put in a different email address. But you can, you can run this platform forever for free, and just take the trades on the live platform you're trading. But Thinkorswim, Awanda, there's a few platforms that have an API that allow us to bring your data feed over. You actually trade right off a NinjaTrader. And if you're on TD Ameritrade, Thinkorswim, they'll execute right on here and add the money to your account on Thinkorswim. Sure. Yeah, hey, look, see the stop right here? Let's say you're taking, now this is not a short trade, but let's say you're taking a trade short here. Your stop is 1 tick above the high of the candle. The reason being, the high of the candle acts as an area of weak resistance. So you want to break the resistance and get 1 tick further. That will always be where this line is. 1 tick above the high on a short trade and 1 tick below the low on a long trade. So I hope that makes it clear. Like if you were here looking at this candle, the line would be right here, 1 tick below. But now every candle it's going to move, because it's going to give you a different stop based on where it would be if you took the trade on that candle. So if this is an execution, your stop just sits here. If you want to move it to first target, which is what we do automatically, that's programmed into the ATM. Sergio can do that for you. Your stop will just move there automatically at first target. But that's where your initial stop is. And that's where it should be based on market structure and price action. If you take it higher, the trade it's busted once you break the high of the previous candle. This is where it should be. And it's the tightest stop you can possibly have. If you go higher, you're wasting money. If you go tighter, you're going to get stopped out on stutter. I hope that makes that clear. Hey, thank you, JP. Hey, you too. You have a wonderful weekend. No, Pri, these are all, you got it. Price action, volume, order flow, you got it. And let me tell you something. These are leading indicators. Trust me. And let me just show you this. Let me squeeze this up like this. Now remember, this assessment is not looking at price on your trading chart. It's looking at your higher time frames. And look how they lead price. Price is not turning these green. The fact that they're green is driving price up. And look what happens when you get a predominance of red. It's driving price down. And these lead the market. If I told you that these colors were being formed by the candle bodies on your chart, they ain't worth nothing. They're always going to be red when price goes down and always going to be green when price goes up. But they don't look at price on your trading chart. Trust me, they just don't. And if you open this up, this is a 4 Unorenco. The input here is a 13 range. It's not even looking at a Unorenco. It's looking at a 13 and 21 range. It's it's sophisticated analysis. And that's based on mathematical modeling. This indicator is assimilating data from 2 higher range charts. not even Unorenco's. So believe me, these are leading indicators, and order flow is the same way. The way I described it is exactly the way the calculation is done. Yeah, close to the 50 MA. You wait for the bar to close. 8 APN. Sure, I will send you info on the option service, Dwayne. No, Khalid. 2 or 3. You listen, you can put your stop 2 or 3 ticks above or 2 or 3 ticks below. I just believe, based upon market structure, if it breaks the candle high and goes that 1 tick, the trade's not going to, you're going to lose the trade. If you want to look, you can raise it 5 ticks above if you want to. This is just the software's recommendation. You always have discretion to trade it how you like. I just would not take more risk on it, because once it breaks that line, I consider the trade to be in free fall, or free fall to the upside. You've lost your trade, and that's just my humble opinion. Okay, guys, listen, I really appreciate it. Thank you so much for giving me your time. I hope you'll come aboard, because I'm telling you, we make money, and this is a leading system. Now, who wants, Dwayne, you want information about the Options Alert newsletter? I'll be more than happy to send it to you. I mean, we've amassed a great track record, and we're in really good positions. I like every position we're in. We only have one busted position. I took a pot REIT, the best one in the world, Innovative Industrial Properties, it's called. I don't want you, it's Innovative Industrial Properties, IIPR, and it just collapsed, along with all the pot stocks. But our techs are doing great. I love this this Brazilian 4G, and I want to be in silver. So that's really it. We've scaled out of a lot of our positions. I mean, we closed 5 this week, because my mantra is, you sell in a massive bull market, you sell into it, and you buy into a big pullback, buy into a retracement. And silver collapsed, and I think it collapsed even more. But precious metals, I think, are going up. All right, well, listen, everyone. Have a wonderful, wonderful weekend, and hope to see you aboard. Either way, I hope you took some good information away from this, so that when you do day trade or you do swing trade, and it comes, I'll do this really quick, and I know it's a pain, but I'll do it to the one trader that asked. Hang on a second. If you hold on 1 second, I'll show you Apple. Let me connect it. Hasn't connected yet. Give me a second here. All right, it is connected. I should be able to dial in Apple. Here we go. Now, does Apple look any different than the NASDAQ? Nope. Doesn't quite make it, but there's your trade. Right on the pullback. Right down. Now, the time frame's irrelevant. The size of the move is irrelevant. All that matters is that these leading indicators are giving you great entries. That's all that matters. This long trade can't take. Both legares are yellow. No trade. Here's a short trade. It's not a big one, but again, this is definitely a winning trade. And look at this beaut all the way down. There's no losers here so far. Now you're trading into support and you have no trades here. There's your pivot break and there's your short. Oh, you can't take it. Order flow is blue. So you're gonna have to wait until it turns. Now this might be a trade you can't get into because on the pullback, you don't have order flow with you. Makes it a riskier entry. So just forget about it, as we say. See what happens? It bounces right off support. Now I didn't go into the uniqueness of this pivot, but it actually is the candle body, not the wick. And it's very, very powerful. This is just a little bit too extended to take a trade. I'm not crazy about this, but this is a pretty decent move down. But it's right into a pivot. Here you have nothing. And here's your stellar trade. Right near mean price and your move up. I would not take a continuation trade. And you see it went up. It flew, but I would not have taken it because you could have taken it. See here, you're censored. See the long-term legare? It's orange. Can't take the trade. Here it's censored. Order flows in the wrong direction. Here it's censored. And the only place you could take it is here. And it's too far up. You're not going to get every winner, but you want to avoid every loser. And that's the day. There's really no losers. And this is just, doesn't matter what time frame you're trading. And this is the apple right here. Okay. If you want 50 bucks a day, I'm telling you, you're going to get it. I mean, that's one contract, one winner, Pre. What can I tell you? That's a first trade winner. And I will tell you one analysis that I can tell you is really very valid. The early morning trading gives you a much higher percentage of winners than the later morning. Like between 9 and 10:30, my win percentage is incredibly high. And then from 10:30 to, let's say, 11:30 or 12, it falls off. It gets a little bit weaker. So you're looking for one winner. I mean, you're going to achieve it. I wish I could. I wish I could ink that in blood, but the probability of having that happen is exceedingly high. That's all I can tell you. And you can see Apple is trading. If you look in the lower right-hand corner, this is now not the number of contracts, it's the number of shares. And it's very small. I mean, for Apple to trade 5,000 shares, it's a joke. All right, everyone. I just wanted to show you stock. And if I showed you a Forex market, it would be the same thing again. Hey, Pre, it's okay. I really am. In all honesty, trust me. And I'll work with you too, believe me. No, Sophie, on MT4, you'd have to run the system off of a demo and take the trades on it. I get so many MT4 requests. We're going to move to it, but it's so complex. This multi-timeframe analysis, it would take us a significant amount of time to go to 4. If you really want to trade these things, and they're not hard to trade on another platform, you're going to have to take the entries on MT4 and run this off a demo. Won't cost you anything. It makes it a little more complex, but you will get great entry signals. I can tell you that. And remember, we configure everything for you. There is a scanner. Oh, my pleasure. My pleasure, Pretty. There is a scanner, Sophie, but that's an independent piece of software. I have it around here somewhere. We do have one, but that is not, I mean, it's right here. We call it a market analyzer. I don't really have it configured. It's just looking at gold right now, but it can look at gold, it can look at Apple, it can look at anything, it can look at any time frame, and it does give you really great buy sell signals. It's totally configurable. This is a 2-5-10 Unorenco and a 4-10-20. This can be a 2-minute, a 5-minute, a whatever. That's our scanner, and it works really well. So we do have one. It's just not included in this. And if you want to go, that's my last thing, and then I'm going to run away, is to go to a 5-minute. On the Apple. It's going to take a minute or so to kick over. Just give it a second. I don't see anything happening. I think it did it. This is the 5-minute. It happened really quick. Now the thing I have to do is go into the MTF legare and change it to a minute. And remember, it's going to go to 15 minutes. And it's going to know to go to the 45-minute. And let's change the color. And look at the 5-minute chart. Look at right here. Look at that. Oh, free. I mean, everyone's going to run me out of town here. Hold on a minute. I'll do that really quickly. I don't have a lot of time. I don't have very many days. But I'm telling you, a 5-minute, it doesn't make any. The time frame is irrelevant. As long as you're above the 50 and above the 15, and you get dual greens, and look how order flow is with you on this whole trade, you're going up. And you want a 5-minute on the E-mini, I'll do to the E-mini, and we'll do a 5-minute. Now there's your 5-minute on the E-mini. Kaboom, here, gigantic move down. Here's your move up. That's it. And here's another move. Well, you can't take that trade. You have two trades. This one short, and you have this one long. That little window in there where they're yellow, yellow. And there's your long trade. That's it. And this is really your stellar trade on a 5-minute. Right here at 9:35. That's a lot. Your entry is going to be right here. And your maximum excursion on the trade is 8 points. I mean, if you make 8 points on the E-mini on one trade, go back to sleep. So that's all you need. So it does not matter what your time frame is. That's your $50. Let me tell you, 8 points is a lot more than $50. I mean, if you got 5 of those 8 points on one contract, that's a lot more than $50. That's more like $300. So then you don't have to trade for the whole week. You're done because you've surpassed your 50 per day, and you can trade the following week, Pre. Listen, no, the micro moves just like the regular. The only difference is the value of the contract. If I went to the E-mini micro, it would look identical. Price is identical. You can trade the micro. It's just when you go to the micro chart, I think it goes to $1.25 a contract instead of a tick, instead of $12.50 a tick. Okay, listen, I'm going to run because I've taken up way more time than I wanted to. It's at 2 hours. I think you've got a great feel for the system. Okay. You listen, Pre. I think in the beginning, to learn the system, the micro is a great way to go. You'll make a small amount of money, 50, and your potential losses are tiny. And I think that's a terrific idea to go that way. One of the biggest mistakes traders make is they start trading big amounts of money early on when they don't really have a great feel for the system. And you want to watch it, and you want to trade it in sim for a while. And then when you're consistently profitable, you go to live. And the learning curve here is so short, especially out of the master class. I'm going to show you every configurable entry. And there are three. And pivot break, retracement, and I'll show you the third. So everyone have a great weekend. Hey, Ken. Ken writes, I've been training with Mark and his team now for 3 years. I can not only say his system is terrific and the support of right line trading is almost immediate. Thanks, Mark. Ken, thank you so much for those words of wisdom, that compliment. I really appreciate that. I really do. And Sophie, thank you. All right, everyone, have a great weekend. Really enjoy, rest, and Monday, let's hit this market and beat the living daylights out of it. It's always my attitude. So take care and have a great weekend. Bye-bye.